Brad Williams, Frugal Finance. The question posed here is, if I'm considering an adjustable rate mortgage, what should I look out for in the fine print? If you're considering an ARM, make sure to read the terms carefully and ask lots of questions until you understand exactly how each of these features of the mortgage work. They're confusing. You're going to have an index. You're going to have caps. You're going to have margins. You don't understand those four components. You're going to scratch your head going, I don't really get this. Adjustable rate mortgages can be very complicated. There are many parts to an adjustable rate mortgage that can affect how much the mortgage will cost you. Here are key questions to ask your lender about your loan. When and how often will the interest rate be adjusted? Most adjustable rate mortgages have fixed interest rates for an initial period. For example, 3 or 5 years are typically recalculated once per year after that. But this structure is not required. Some loans don't have an initial fixed rate period and they can adjust more or less frequently. Make sure you understand exactly how often the rate of your loan will readjust. You can have a 1-year adjustable rate mortgage. It could be indexed to the 3-month treasury. The 3-month treasury bill is very volatile. It is considerably lower in overall price, but there's going to be a margin attached to that, and it could be significant. So theoretically, you could have 3-month adjustable rate mortgage, possibly adjust 4 times a year. And if it's on a very volatile index, you could be surprised at how reckless your payments could be. Reckless, not on your part, but in terms of the overall cost to you. Be very careful. What is the index and margin on a loan? The index and margin control what your interest rate will be at each adjustment for an adjustable rate mortgage. Learn more about indexes and margins and how they work. I have a lot of YouTube videos available. Just check the playlist under mortgage, and if there's not a video that addresses your concerns, comment, and I'll do what I can. What are the caps on the loan? Rate caps control the maximum amount your interest can change at each adjustment and in total over the life of the loan. Learn more about rate caps and how they work. For example, you could have a 1-year treasury. I use that 3-month treasury, but you could also use a 1-year treasury. Right now it's at 4.24%. That would be your index. Then there could be this cap. And it could be on a monthly and an overall basis. Let's say it's 2%. Every adjustment, the index could go up 2%, depending on what your margin is. Confused? Yeah. And then over the total life of your loan, you could have a max cap called the ceiling, and it could be 6%. If you signed your loan, the index was at 4.24%. The maximum amount your rate could go would be 4.24% plus 6%. Can you afford a mortgage at 10.25% interest? Will the payment be recalculated at the same time as the interest rate? For most loans, the payment is recalculated each time the interest rate adjusts. However, some loans may recalculate the payment amount less frequently. If your interest rate has increased but your payment has not, your loan balances could increase. Can your loan balance increase? Sometimes the balance of a loan can actually increase rather than decrease, even though you're making payments on the mortgage. For example, your loan balance might increase if your monthly payment is not enough to cover the interest on your loan. Check to see whether the balance on your loan is allowed to increase after closing. These types of loans are called negative amortization loans. Check out my video on negative amortization loans. Does the loan have a floor? The interest rate adjusts up. Can it adjust back down in a future period? Some loans have a floor rate or a minimum rate. Even if the index goes lower, the rate on these loans does not adjust below the floor rate. Loans can also have a clause that says that the interest rate can only ever adjust up, not down. I would say you'd want to avoid that type of loan. Both of these features can make the loan more expensive and risky for you by increasing the chance that your payment will go up in the future. If you're considering a loan with either of these features, ask the lender what benefits you would get for accepting these terms. Ask for a quote for a similar loan without these features so you can make an informed decision. Does the loan have a prepayment penalty? Check to see there is a fee for paying your loan back early. Most loans do not have a prepayment penalty, but it's a good idea to double check. Learn about prepayment penalties in the video I have under the playlist Mortgage. Comment, let me know if you're confused about adjustable rate mortgage. A lot of moving parts. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps you soon.